China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up.
For decades, the Federal Reserve and major financial institutions have operated a system that masks the true value of gold by relying on paper claims rather than physical reserves. Recently, however, cracks in this structure have begun to surface. Analysts point to the widening disconnect between gold's record price highs and the declining physical inventory reported by ETFs such as GLD. While the charts reveal gold's price breaking out to new levels, the tonnage of physical gold backing these claims remains stagnant or even shrinking. This disparity raises serious questions about who is withdrawing real bullion from these vaults and whether the system can continue to function under the weight of such inconsistencies. MikeMaloney highlights that this imbalance is not just a technical anomaly, but a sign that the world is beginning to lose confidence in the paper promises underpinning our monetary system. At the heart of this issue lies the opaque practice of gold leasing. Under this system, central banks and large holders lease their gold for a small yield, while retaining the illusion that it remains safely stored. The reality, however, is that through rehypothecation, the same ounce of gold can be leased and released multiple times, creating layer upon layer of paper claims on the same physical asset. Estimates suggest that 1 ton of real gold could support as much as 100 tons of paper gold transactions. This highly leveraged framework works only as long as few investors demand delivery. But should confidence erode, the system would be unable to meet requests for actual bullion, sparking a crisis akin to a bank run in the gold market. The danger of such a system is not theoretical, it has precedent. If a wave of investors were to call in their claims for physical delivery, the spot market would be forced to absorb massive demand overnight. Analysts have suggested that in such a scenario, the gold price could spike to $25,000 an ounce in a matter of days. MikeMaloney argues that this structure effectively suppresses gold's natural price, keeping it far below where it would trade if only physical supply and demand were allowed to set the market. What we see today as a rising gold price is, in truth, the falling purchasing power of fiat currencies against an asset that has held value for millennia. Before we dive into Mike's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves, but this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation. Moving on. ShadowStats John Williams hasn't updated for a couple of years. Actually, I spoke with John just a couple of weeks ago, and his website broke a couple of years ago, but he does have a newsletter that he emails out to anybody that signs up. So you may want to sign up for that. And so I reverse engineered his data set and its relation to the CPI and filled in the last 2 years. And the results are eye-popping for gold and silver.
Beyond the mechanics of leasing, this dynamic underscores a broader truth about monetary systems. Paper instruments and fiat currencies are always vulnerable to overextension and abuse. History shows that governments inevitably debase their currencies in pursuit of short-term relief, but gold stands outside this cycle as a neutral measure of value. Recent reports of discussions around gold-backed treasury bonds, and even whispers of a return to a gold standard, reflect the desperation of policymakers searching for credibility. Yet, as Maloney notes, a gold standard itself opens the door for future manipulation through fractional reserves. What the world needs is not another layer of promises, but a transparent system where value is directly tied to physical assets. This shift is not abstract. It is already happening in places like Venezuela, where supermarkets now price goods directly in grams of gold. Such examples illustrate how real money reasserts itself when faith in fiat collapses. The lesson is clear. Gold and silver are not merely hedges against uncertainty, but the foundation of honest value in a world of financial engineering and currency decay. As Maloney emphasizes, this is more than a cyclical bull market. It is part of a global monetary reset. The real question is whether the public will once again be trapped in a manipulated system, or if, this time, society will finally return to valuing wealth in tangible, incorruptible terms.
Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself. This was a lot of the premise of my first book. Jim Rickards wrote a great article, The Truth About Fort Knox and Gold Leasing, that was on Zero Hedge, but it's the end of the article that is important. The gold leasing scheme. There's another even more insidious reason why Trump and Musk backed off from their Fort Knox visit, even allowing for the fact that the gold is actually in Fort Knox. The deeper question is whether that gold is leased. I mean, I don't have the document in front of me, but I would bet anything they can't do this until the leases have been unwound, but there's big consequences, as you'll see in a moment. The gold leasing is an established market, but not well understood by non-specialists. Even experts in stocks and bonds know little about gold leasing. Basically, it's a way for a gold holder to earn a return. Gold does not pay dividends nor interest like stocks and bonds, but you can lease it to a third party and make 2% or so annually in lease payments. The party leasing the gold does not back up the truck and take it away. The gold stays in the original vault. The gold leasing is purely a paper transaction. The gold lessor gets the lease payment. The lessee gets what's called the right of rehypothecation. That means the lessee can lease the same gold to another party, and that party can lease it to a fourth party, and so on. With rehypothecation in play, 1 metric ton of gold could support 100 metric tons of paper gold transactions. At each step in the chain, a party acts like they own the gold for its own purposes of further leases or sales of unallocated gold. Everyone has price exposure and can make money make currency. If the price of gold goes up, in other words, the dollar goes down, or lose currency if the price of gold goes down, or the dollar gains a little bit against gold, but that's always temporary. The same principle applies to gold futures, gold options, gold swaps, gold ETFs, and the entire world of gold derivative transactions. The point is that the paper gold world is leveraged about 100 to 1 to the physical gold world, starting with the physical gold in Fort Knox, and I have to add West Point and Denver, because it all depends on how much has been pledged by the U.S. Treasury to the Federal Reserve in the gold notes. The danger is obvious. It's no different than any run on a bank when it comes to bank deposits. If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox. For the masterminds of the paper gold market at J.P. Morgan and Goldman Sachs, the less said about gold, the better. They need to keep the game going, and that's why Trump and Musk won't be showing up at Fort Knox anytime soon. For the rest of us, the solution to this problem is simple: buy gold. So that's what Jim Rickards say. I never advise people to buy gold or silver. I say what I'm doing, and I've bought a lot of gold and silver. I've accumulated, and I don't sell. And so I do believe, though, that Trump wants to go back on a gold standard, but it would require unwinding all of these gold leases first, and to unwind those gold leases, shrink. Right now, if 1 metric ton can support 100 metric tons, and this is like a maximum, I think, that Jim is estimating here. It probably isn't 100, but if the entire paper gold world is leveraged about 101 to the physical gold world, that means that the entire gold market is hallucinating that there is 100 times more gold out there than really exists. And that means the price is suppressed from where it would naturally be trading if they were trading real gold. But they're not. They're trading hallucinations. And so I said that the Treasury isn't leasing this gold. It's central bank gold leasing, which is a proven market. It absolutely exists. And here's where our gold is. If you go to the Federal Reserve, this is federalreserve.gov, and you go to their H.4.1 release of Federal Reserve balance sheets, factors affecting reserve balances. You scroll down to the very bottom, and the very last table in here is collateral held against Federal Reserve notes. And so this is currency in circulation. It's the $20 bills in your wallet. And here is the gold certificate account, $11,037 million, and at the statutory price of 42.222222 out into infinity dollars per ounce. $11,037 million, I believe, is 99.7% of all of America's gold, which is your gold and my gold. It's not their gold. This was nationalized by Roosevelt illegally, basically, violating Article 1, Section 10 of the Constitution of the United States, which is a treasonous act to do that, and nationalizing America's gold. When somebody uses the word confiscation, they're usually using it as a scare tactic to get you to buy something that's overpriced.
The momentum building in gold and silver is pointing towards something far more profound than a temporary upswing. With physical supply tightening, industrial demand surging, and fiat systems showing signs of fatigue, both metals appear poised for a structural repricing that could redefine their roles in the global economy. Gold is likely to extend beyond its previous highs as nations and institutions quietly accumulate it to anchor credibility, while silver's dual function as both a monetary and industrial asset positions it for explosive gains once supply imbalances collide with accelerating clean energy demand. If current pressures persist, the market could transition into a phase where gold and silver are no longer just alternative assets, but central benchmarks of value, signaling a shift away from paper promises toward tangible wealth that reshapes the entire financial landscape. That's it for today. If this video provided value, please like, share, and comment below with your thoughts. Your perspective helps deepen the conversation and keeps everyone informed.